Hello, welcome to Investing 101, Lesson 6, Index Funds and Mutual Funds. In this lesson, we're going to talk about a couple easy ways that you can get a really diversified portfolio.
Here we go.
Now, theoretically, you could just go out and pick 15 to 20 stocks and get a fairly diversified portfolio. But it's going to take a lot of time for you to figure out what are good stocks to buy, and then it's going to take you a lot of time to keep tabs on those stocks after you buy them, because you're going to have to make sure that those companies are still doing well. So if you're just getting started with investing, you probably don't have the time or the knowledge to do a really good job of picking stocks.
There are a few who can.
One popular alternative to picking stocks is mutual funds. Now, a mutual fund is a diversified investment product managed by a financial professional that investors can buy into. So if you decide to invest in a mutual fund, you'll buy shares from whatever company is managing that fund, and all that money will be dumped into a collective pool of cash, along with all the other money that has been contributed by other investors. The fund manager will decide what assets the fund will own, usually stocks or bonds, and then everyone in that fund will be invested in the same thing. Everyone will profit or lose money equally, in proportion to how much they have invested in the fund. As an example, let's take a look at the Madison Dividend Income Fund. The fund currently has about $112 million in assets, which means that collectively, investors have contributed about $112 million to the fund.
Good gracious me.
That $112 million is divided into shares worth about $24 each. The fund currently owns 43 stocks, but it owns more of some stocks and less of others. For example, 4% of the fund is currently made up of Johnson & Johnson, while 1% is invested in 3M. This means of the fund's $112 million in assets, about $5 million is invested in J&J, and $1.25 million is invested in 3M. So let's say that you, as an investor, decided to invest $10,000 in this fund. Your money would be divided in exactly the same way as the rest of the fund. About 4%, or $400, would be invested in Johnson & Johnson, and 1%, or $100, would be invested in 3M. So, mutual funds are a great way to get an easily diversified portfolio. You don't have to go out and find 43 different stocks to buy. You just buy shares in the mutual fund, and the fund manager will do all the work of deciding what, how much, and when to buy. But there are actually a couple big problems with mutual funds. First, they can be very costly. A lot of these funds charge very high fees to manage your money. Second, it turns out that fund managers actually aren't that good at picking stocks. 80 to 90% of the time, these funds underperform the stock market as a whole. Let's take a look at what type of fees these funds charge. First, many funds charge a sales commission or a front-end load when you buy shares in the fund. Say, for example, that the fund you bought had a 5% front-end load. This means, of that $10,000 purchase we made earlier, we would have been charged $500 in sales commission. Some funds also charge redemption fees, which is a fee when you sell your shares, and others charge a service or marketing fee of 1%.
We can charge anything we want, $2,000 a day, $10,000 a day, and people will pay it.
Finally, all funds have what's called an expense ratio. Now this covers all the costs of researching the stocks as well as the costs of buying and selling them. For example, the Madison Dividend Income Fund has an expense ratio of 0.95. This means that for every $100 that you invest in the fund, you'll be charged a yearly fee of 95 cents. This doesn't sound like a lot, but it can really add up. So let's say on our $10,000 investment, we made 5% last year. It's not a great year, but it's not bad. So a 5% return means we made $500. But if you take out the $95 that the fund charged us, we actually only made $405. This really adds up over time because it robs you of the ability to compound your return. In fact, over 30 years, if you averaged a 10% return in this fund, the expense ratio would end up costing you $40,000.
Oh. Okay.
So yeah, mutual funds can be costly. But if they get you a better return for your money, then they can't be that bad, right? Well, as I mentioned earlier, it turns out that fund managers really aren't that good at beating the market. Mutual funds underperform the market 80 to 90% of the time. Fund managers just aren't that good at picking stocks because the stock market is a very difficult thing to predict. And even those fund managers who do beat the market usually don't beat it by enough to overcome the fees that the fund charges. Fortunately, there's a really good alternative to mutual funds: index funds. Instead of trying to beat the market, index funds simply try to be the market.
To be or not to be, that is the question.
Index funds are actually a type of mutual fund, but they're not actively managed. This means that there's no fund manager spending a lot of time researching stocks or trying to figure out what to buy. Index funds simply try to match or track a particular index, such as the S&P 500. If an index fund is tracking the S&P 500, that means it's going to own all 500 stocks that are part of the S&P 500. Some index funds even try to track the entire US stock market, owning thousands of stocks. The big advantage of index funds is that they are extremely cheap to own. Many have expense ratios of 0.05 or less, a big difference compared to the 0.95 we talked about earlier with the mutual fund. On top of that, since index funds are just trying to match a broad segment of the market, that means they're going to outperform regular mutual funds almost all the time. So with index funds, you're going to get a better return at a fraction of the cost. Most mutual funds and index funds are bought directly from the financial institution that issues the fund, such as Vanguard, BlackRock, or Fidelity. In the next lesson, we're going to talk about a different type of fund: ETFs, exchange-traded funds. These funds are bought and sold on stock exchanges, just like stocks. We're going to explain further about exactly what an ETF is, compare them to index funds, and talk about their pros and their cons.
Oh!